On the surface, Japan's office market in early 2026 looks amazing. But if you scratch beneath that shiny exterior, you'll find something else going on. A really deep structural change is happening. You know, the old rules, they just don't apply anymore. The very idea of what makes a good office is being rewritten as we speak. So let's dig in and figure out what's really going on.
Right, and this is the central puzzle we need to solve. The economy's doing great, companies are hiring like crazy, and profits are way up. So, why is it so hard to find the right kind of office space? It's not just a simple case of supply and demand. As we're about to see, it's really a story about selection. To get our heads around this, we're going to break it down into 5 key parts. First, we'll look at the solid economic foundation. Then, we'll see how that's causing a major shift in how companies think. After that, we'll tackle why rents just keep climbing, uncover the massive divide it's creating in the market, and finally, wrap up with what this all means for the new reality of office real estate.
Okay, first things first. Before we can even talk about buildings and rent, we've got to understand the big picture, the health of the entire Japanese economy. It all kicks off with this number right here. In late 2025, Japan's real GDP growth was a solid 1.7%. Now, I know that might not sound like a huge number, but trust me, after years of things being kind of flat, this was a massive signal that the economic engine was finally firing on all cylinders, and that gave businesses a major confidence boost.
And it's not just that one GDP number, it's the whole story. We're talking about super low unemployment, more jobs and people to fill them, and companies making great profits. This creates this awesome feedback loop. Confident companies start investing more. And here's the key part for us, they start investing in their people and their workplaces. This is the bedrock for everything else we're going to talk about.
So, a strong economy gives companies the green light to grow, but it's doing something even more profound. It's completely changing how they think about their office space. An office isn't just some number on an expense sheet anymore.
In this slide, it captures the single biggest change in strategy perfectly. For decades, the name of the game was simple. Treat the office as a cost to be squeezed. Cut the budget, reduce the space, find a cheaper spot. Well, today, that thinking has been completely flipped on its head. Now, the office is seen as a vital investment in a company's #1 asset, its talent.
It all boils down to what people are calling the talent war. With unemployment so low, every company is fighting tooth and nail to hire and keep the best people. All of a sudden, a top-tier office, great location, modern features, a focus on wellness, it isn't a luxury anymore. It's a critical strategic weapon in that war for talent.
Okay, let's recap. We've got confident companies, and they're all looking for a much better class of office building. So what happens when all that new demand hits the market at once? You get a major squeeze.
I mean, just look at this number, 1.05%. That's the vacancy rate for top-quality offices in Tokyo's 3 main business districts. That's not just low. For all practical purposes, it's 0. It means for all those companies hunting for a great space to attract talent, well, there's pretty much nothing out there. The market is unbelievably tight. It's kind of the perfect storm, really. You've got this huge wave of demand from companies wanting to upgrade on one side, but on the other, the supply is totally stuck. Costs for materials and labor have gone through the roof, which makes building new premium offices super difficult and expensive. It's basically choking off the pipeline of new space.
And here's the direct result of all that pressure. The average asking rent in central Tokyo has shot up to over 32,000 yen per tsubo. That's the standard Japanese measurement, about 3.3 square meters. This actually brings rents right back to where they peaked in 2020. It's the clear financial outcome of this intense market squeeze.
And this quote from the research really sums it all up. This isn't just some temporary blip that's going to go away. Those high construction costs are now baked into the rents, creating a fundamentally new and permanently higher cost for office space. This is the new normal.
Now, you might think a hot market like this is good for everyone, right? A rising tide lifts all boats. But that's not what's happening. In fact, it's creating this huge divide. A tale of 2 markets, really, between the winners and the losers. And that's true for cities, and even more so for individual buildings.
You can see this playing out all across Japan. Fukuoka is a perfect example. Their Tenjin Big Bang redevelopment was exactly the kind of high-quality space the market was craving, and it led to record-breaking rents. Osaka is also super tight. Then you have cities like Nagoya and Sendai, which are also strong, but they show how a bit of new supply can start to change the game internally.
But as important as which city you're in is, the data is showing us something even more dramatic.
The biggest gap that's opening up is based on the quality and the size of the buildings themselves. This is where that story of selection gets really sharp.
This chart, wow, it just says it all, doesn't it? Look at that difference. The vacancy rate for those big, modern buildings in Tokyo, that's the 1.05% we saw before. But for smaller, older buildings, it's all the way up at 3.80%. That's nearly 4 times higher. You are literally looking at market polarization on a single slide.
So what this really means is that the economic boom isn't creating one single strong office market. Nope, it's creating 2 completely separate markets living side by side. All the good stuff, the high demand, the rising rents, it's all flowing to one specific type of building, while everyone else is getting left behind. All right, so where does this leave us? In this new divided market, what's the one thing that's going to separate the winners from the losers? What does it take to succeed?
Well, it all comes down to this one idea: cost pass-through power. It's a bit of jargon, but what it means is simple. It's the ability of a building owner to not just raise the rent, but to actually convince tenants that the higher price is totally justified because the building itself provides real, superior value.
So what is this added value we're talking about? Well, it's things like great environmental performance. It's having a solid plan for emergencies. It's features that actually make employees feel good. And of course, it's having big, efficient floors in a great location. These are the things that help the tenant's business succeed, and that's what they're willing to pay a premium for now. But here's the flip side. For buildings that don't have all that added value, the risk is huge. It's a problem called secondary vacancy. And it's a double whammy. Your current tenants move out because they can't afford the rising rent, and then you struggle to find anyone new to take their place because your building just can't compete anymore. Which leaves us with this final big question. This new market is forcing everyone from building owners to the companies renting space to ask, what does value really mean anymore? It's pretty clear it's no longer just about 4 walls and a roof. It's about performance, it's about people, and it's about being a strategic partner for the businesses inside. The very definition of a good office has changed, and I think it's changed for good. I hope this explainer helped you see the deeper story behind the headlines of the office market. If you found this breakdown useful, we'd really appreciate it if you give it a like and subscribe for more deep dives like this one. Thanks for watching.